Nvidia's upcoming earnings report could single-handedly trigger a market swing exceeding $600 billion. That single move equals the entire market valuation of Tesla. Next week brings the most volatile trading window of this entire quarter. Most retail investors will lose money by reacting to headlines instead of positioning early. The week commencing August 24th brings a rare alignment of catalyst events. Central bankers gather at Jackson Hole starting August 27th. Nvidia reports second quarter results on August 26th. Analysts project revenue to climb past $91 billion. That represents 97% growth year over year. Options markets price in an 8% move for Nvidia stock. Because Nvidia anchors every major technology fund, its movement ripples globally. A topside surprise lifts the S&P 500 and European tech indexes immediately. A misstep triggers cascading liquidations across algorithmic momentum strategies. What most people don't know is that big institutional funds are already adjusting cash positions. They are rebalancing portfolios before the retail market reacts to press releases. To navigate this volatility, beginner and intermediate traders must target structural strength. In the United States market, Nvidia remains the mandatory tech reference point. Shares trade near key resistance ahead of the Wednesday earnings call. Earnings per share are expected to hit $2.09. Retail buyers often make the mistake of buying call options directly before earnings. Implied volatility crush destroys option value right after the announcement. A safer equity strategy involves accumulating shares via fractional order blocks. This strategy lowers your cost basis if the stock pulls back before earnings. Outside of tech, healthcare offers strong defense during central bank volatility. Eli Lilly continues to demonstrate robust balance sheet momentum. Strong global demand for metabolic health drugs provides steady cash flow. The stock operates with low correlation to interest rate chatter from central bankers. In the European region, SAP offers software exposure without hardware supply chain risk. The German software giant provides enterprise cloud solutions across global logistics. Enterprise cloud migration stays strong even when hardware infrastructure spending cools down. SAP trades at a valuation discount relative to American software peers. Its long-term recurring revenue model shields it from sudden inflation spikes. Before you skip to the end, look closely at the United Kingdom market. British stocks offer reliable, high-yielding value dividend opportunities. Shell provides direct energy exposure while trading at lower multiples than U.S. rivals. UK inflation recently rose to 2.9% due to domestic energy caps. Higher energy prices increase profit margins for integrated oil majors like Shell. Their aggressive share buyback programs generate consistent cash yields for shareholders. Broad market exchange-traded funds offer crucial protection against single-stock headline risk. The iShares Core S&P 500 ETF provides core exposure to top American companies. Allocating to broad index funds prevents total portfolio damage if tech earnings miss expectations. Broad market indexing remains the foundation of institutional portfolio construction during earnings season. For European market coverage, consider the Vanguard 50 developed Europe ETF. This fund captures large-cap equities across Germany, France, and Switzerland. European equities benefit from steady interest rate cuts by the European Central Bank. Lower regional interest rates reduce borrowing costs for industrial exporters. For thematic exposure, the iShares Semiconductor ETF tracks the global chip ecosystem. It holds Nvidia, ASML, and TSMC in a single fund package. This structure captures long-term artificial intelligence infrastructure growth while reducing single-company risk. If Nvidia reports strong guidance, the entire ETF advances together. Now is the exact right moment to subscribe to the channel. Hitting the subscribe button ensures you receive daily financial updates every morning. Our real-time execution guides help you stay ahead of Wall Street institutions. The bond market is sending signals that equity traders are completely ignoring. United States Treasury yields remain jumpy ahead of the Jackson Hole meeting. Federal Reserve officials meet to set global monetary expectations. The short end of the yield curve offers attractive, risk-free returns. The iShares 1 to 3 year Treasury bond ETF provides ultra-safe income yield. Capital stored in short-duration treasuries earns predictable monthly yield distribution. This asset acts as financial armor if stock market volatility spikes. The surprising part comes next regarding United Kingdom gilts. UK inflation figures hit 2.9%, keeping gilt yields elevated. Short-term British government bonds offer strong income for sterling-based accounts. Cash sitting idle in bank accounts loses buying power against rising living costs. Moving excess cash into short-duration treasuries preserves capital while keeping money liquid. Executing this trade strategy requires a disciplined process for next week. Allocate 40% of new capital into broad equity index funds. Put 30% into high-conviction global stocks like SIP or Shell. Place 30% into short-term treasuries to maintain cash reserves. Never place market orders during the first 30 minutes of trading. Institutional, high-frequency algorithms generate artificial price spikes right at the opening bell. Wait for price action to settle after initial economic news drops. Use limit orders to ensure you purchase assets at your targeted price. Look out for our next video posted daily to master your portfolio strategy.